everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX VettaFi. Today we're going to highlight the major economic news from the week of August 11th through the 15th. It was a bit of a roller coaster for the markets. The S&P 500 hit several new record highs, but the momentum cooled as economic data painted a mixed picture, particularly around inflation. Speaking of inflation, let's look at our first chart. The Consumer Price Index, or CPI, for July came in pretty much as expected, with headline inflation holding steady at 2.7%. But the Producer Price Index, or PPI, which measures inflation for businesses, told a very different story. It jumped by 0.9% in July, its biggest monthly increase in over 3 years. This is a crucial number to watch because the PPI is often a leading indicator for consumer inflation, meaning that when producers' costs rise, those costs can eventually be passed on to consumers. And so while recent CPI reports showed consumer prices have been slow to rise, the latest PPI data is a clear warning sign that future price increases may be on the way. Now let's take a look at consumer sentiment. The University of Michigan's Consumer Sentiment Index fell for the first time in 4 months, dropping 5% to 58.6. This decline was largely driven by rising inflation concerns, with consumers expecting both short-term and long-term inflation to worsen. However, despite this dip in confidence, consumer spending has remained surprisingly resilient. U.S. retail sales rose for a second consecutive month in July. While the 0.5% increase was slightly below forecast, it was supported by a significant upward revision to June's numbers, showing that spending is holding up after a few months of pullbacks in the spring. But probably the most encouraging sign from the report showed that controlled purchases, a crucial GDP input and an even more core view of retail sales, beat expectations with a 0.5% rise. So even with inflation worries and historically low sentiment, consumers are still spending. So how did the market react to all this data? Despite the mixed economic data, the S&P 500 still finished the week up 0.9%, notching 3 new record highs before a small pullback on Friday, marking its 4th weekly gain in the past 5 weeks. As for the bond market, the 10-year Treasury yield finished the week at 4.33%, and the 2-year Treasury yield was at 3.75%. Following the consumer inflation report early in the week, there was some talk that the Fed could deliver an aggressive 50 basis point rate cut at their September meeting. However, that sentiment quickly changed after the much hotter than expected PPI data came out, highlighting mounting inflationary pressures in the pipeline. As a result, expectations have now shifted back to a more modest 25 basis point cut, with markets currently showing an 85% likelihood of that happening at the September meeting. Looking ahead, markets are also pricing in another 25 basis point cut in December, though that could come as soon as October, with a few more expected throughout 2026. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.